Great. Thank you very much, Vicki. It's a pleasure to be here today and to speak to everybody about mortgage financing. This is something I've been involved in for over 30 years, and so I know a lot about it, but I have never seen so many changes as we are now witnessing in the market. So more important than ever that you get proper advice when you launch into the home financing world. What I'm going to talk to you about today is just the highlights, and invite you to contact me afterwards if you have any further questions about this. Let's start with the types of mortgages. Broadly speaking, there's a conventional mortgage, which means that you have at least 20% down. There's also the insured mortgage, which is known as the high ratio mortgage, and that means you have less than 20% down. When you have less than 20% down, it must be insured. So let's talk about high ratio mortgages because that's the most common mortgage applicable to first-time home buyers. So a high ratio mortgage is one in which you have less than 20% down. The minimum requirement is that you have at least 5% down. Insurance premiums will range from 2.8% to 4%, and this is something that you pay, but the vast majority will add it to their mortgage. In fact, I've never experienced anybody saying that they will just pay for the insurance up front. So, having said that, you will have the lender arrange the default insurance for you because it is protecting them, not you. In the unlikely event that you're no longer paying your mortgage and it goes into foreclosure and they sell the house, and there's a shortfall in the sale to cover the mortgage, this is what the default insurance covers. And there are 3 insurance providers in Canada. The lender will choose them and you will pay the premium. Okay? Now, there are several mortgage options available. There are the fixed rate mortgages, the variable rate mortgages, the home equity lines of credit, which you might have heard of as HELOCs, and a combination of any of those items. We won't talk about the HELOCs a lot today because they're less common, but they do have a place for certain borrowers. The vast majority select a fixed rate mortgage, and we're going to start with that. With a fixed rate mortgage, you can have a term of 1 to 5 years, 7 or 10. Now the 7 or 10 year terms are fairly uncommon because typically what happens is as the term lengthens, the interest rate is higher. So the 5 years is kind of a sweet spot for people. It's long enough to give them some protection as to the interest rate and hence their payment amount, but it's not so far out there that the interest rate is higher than it needs to be. Now, with fixed rate mortgages, it's called a closed term. And what that means is if you break it early, you will have a penalty. Now there are ways to avoid penalties, but in the worst case of scenarios, sometimes people are faced with penalties. And it's important to know that not all penalty calculations are the same. And this is some of the fine print that you need a mortgage expert to help you with and point out so that when you're making a selection, it's not only getting a great rate, but it's also the fine print that isn't going to hurt you and cost you money in the long run. 76% of buyers in a 2015 survey selected the fixed rate mortgage. Let's talk about the variable rate mortgage. As you would expect, the variable rate means that it's going to float, and it's associated with the bank prime rate. Everybody's heard about the bank prime rate. Now, the bank prime rate is influenced by the Bank of Canada's overnight rate. And this is what you see on the news about every 2 months, the announcement on what the Bank of Canada is doing with their rate. If they move their rate up, then the bank's prime rates go up, and guess what? Everybody who has a variable rate mortgage will be affected with higher interest costs. So, the variable rate will often provide a lower initial rate than locking into a fixed rate. But if rates start to move up, those savings can disappear. So there is a little bit of guesswork as to which is the best one, and I do have some advice I provide to clients to help them decide between the fixed and the variable rate. It is also a closed term. However, the government rules require that it be no more than 3 months penalty interest. Usually it's pretty reasonable to break a mortgage if it's variable. Often convertible as well, meaning if you think rates are rising faster than expected or expected at all, then you would be able to convert your mortgage to at least the remaining term in a fixed rate mortgage. Now, the catch on that is, by the time you decide that the variable rates are going up too much, the fixed rates have probably already moved too. So you're locking into a relatively higher fixed rate, but at least you can protect yourself from further increases. The adjustable rate mortgage is another term very similar to the fixed rate mortgage. Quite a few adjustable rate mortgages are available in Canada. There's some subtle differences, and that is something that a mortgage professional would explain, but for the most part they both float and they both represent basically a call on whether you think interest rates are going to go up or down. 20% of people chose a variable rate mortgage in that same 2015 survey. Okay, so you can see it's a little less popular. Given that in October there's a lot of sentiment about rising interest rates, I'm suspecting there'll be even less than 20% going with the variable, and that's certainly been my experience. Now, there are some certain common flexibilities amongst all mortgages that I'd like to go over with you. First of all, you can do lump sum payments that will range from 10 to 20% of the initial mortgage amount. This will allow you, if you happen to have a little extra cash sitting around, to throw that on the mortgage, reduce your interest cost, and reduce the total length of time that you have a mortgage, known as the amortization. Another flexibility that I really like is increasing your monthly payment, or whatever your payment frequency is. And that usually allows up to 10 to 20% increase in your payment, so that, again, it's going straight to your principal, reducing your interest cost. And you know what's really nice about doing it this way versus the lump sum? Most people have trouble saving up a lump sum of money and applying it. They always find something else to do with it. However, if you can find it in your budget to add it to your regular payment, you won't even miss it. And then at the end of your term, you'll be so much better off. So that is my favorite one. The other thing that you need to think about is the payment frequency. So lots of flexibility there. Weekly, bi-weekly, semi-monthly, monthly, and people that are coming out of rental situations often like to stick with monthly because they're used to monthly payments. However, they could go bi-weekly now and pay according to their pay cycle, or maybe you're paid semi-monthly. Whatever it is, that flexibility is there, and you can always be more comfortable that money will be in your account when you need it. The other common flexibility is portability. So I talked a little bit about closed mortgages, meaning if you break them, you're going to have a penalty. However, if the home that you initially buy with Vicky is going to satisfy your needs for a few years, but then you move to another house, you can actually take your mortgage to the new house and avoid a penalty on that. The costs of porting a mortgage are usually very nominal, and it's one way that we can help you avoid unnecessary costs. The other thing to consider is transferability. So your mortgage comes up for renewal, and you see a nice shiny opportunity at another lender. Mortgages are generally transferable, again, with little cost, if you can save money on, say, a lower interest rate with another lender. But I will caution you on this. It all depends on the type of mortgage you have. If it's a standard charge mortgages, nominal costs, but some of the mortgages out there are called collateral charges. Again, you want good advice from your mortgage professional to make sure before entering these mortgages, you know what the fine print is. It doesn't cost you more than it should in the future. Lastly, I want to talk about assumability. What assumability is, you sell your home and the buyer says, can I assume your mortgage? Maybe you have a very low rate and they think it's very appealing and they'd just like to take it over. I will just say one thing about that. Very cautious on that. talk to your professional about it, because there can be lasting consequences if the person assuming doesn't look after the mortgage properly. So while it's a feature that's available, I would say caution. So now you know just a little bit about mortgages. The big question I'm sure is going through all of your minds is, how do I qualify? So what we're going to talk about is the 5 C's of credit. And if you were to be trained as a mortgage lender, one of the first lessons you're going to have is the 5 C's of credit. And those 5 C's are character, credit, capacity, collateral, and capital. Let's go through those and see how it fits with you. But before I do, you have to promise that you will not rule yourself out of qualifying because you don't think you meet any one or part of one of these 5 C's. Because these are looked as a complete picture, and not everybody is going to be 100% on everything. But we want you to understand how an underwriter thinks, because it may affect how you prepare to qualify for your mortgage. Let's start with character. So character answers the question, will the borrower repay? And you might wonder, how would a lender know what my character is? They don't really know me. Well, we're talking about financial character, and there's a number of clues that are going to help them understand how financially responsible you are. So for example, do you have good savings habits? Have you been able to put some money aside through your employment and other sources and save up for the things that are important to you? Have you built some net worth over time, accumulated some assets? Let's face it, the younger you are, the less likely you're going to have the opportunity to do those things. Those things are understood by an underwriter. So again, you may not have a lot of that in place. That's okay, it's understandable. The other thing is, how do you use your existing credit? Are you being responsible towards it? And you know, one of the things that surprised a lot of people is cell phone bills. I might pay it this month, I'll catch it up next month. You know, it is a form of credit because, of course, you are buying the phone through your monthly charges. And when you're not routine on that, then that can actually affect your credit score. Okay, so it's just little things like that that can add up. Now, the other one that I like to talk about, or I reflect on, is stable or progressive employment in your field of expertise. You know, if you're investing in your career, that leads to financial stability. And that's something I like to highlight whenever possible. But it is outlined, or it is understood by all lenders and everybody, that there's a lot of employment mobility. And so just because you've changed jobs doesn't mean you're going to have a problem getting a mortgage. But when I highlight things, if that's something that I can say, it just adds strength to your application. So let's talk credit now. So how has your existing credit been managed? Everybody knows that there are things called credit scores. And credit scores range from 300 to 900. Now, I don't see anything in the 300 or 400 range. I've seen some in the 5, but I see a lot in the 6, 7, and even 800 range. And that's the range in which you can qualify for a mortgage. Key to having a good credit score is understanding how it is derived. One of the things that's obvious is make your payments on time every time. Even if it's only the minimum payment and you think, well, the minimum payment's only $30, my lender's not going to miss it, I'll just make my bigger regular payment the following month. Absolutely not. Make at least the minimum payment every month. The next thing is stay well within your limits. So if you have a $5,000 credit card, don't run it up to $5,000 and let it sit there, because it indicates you've used up all of your credit capacity, and that could be an indication of a concern to a lender. So what you want to do is not use more than 50 or 75% of your credit limit and routinely make your payments, and your credit score will actually be strengthened by that. Your time with credit. Lenders are looking for you to have credit established for at least 2 years. So if you haven't established your credit, get that going now. We do have some alternatives, but it's better if you've met that basic criteria. Number of credit accounts, you need at least 2. Again, we have some workarounds on it, but to fully meet the expectations of the lender, have at least 2 pieces of credit. That could be a car loan and a credit card, or a credit card and a line of credit, or even 2 credit cards. And the last thing about it is make sure that your limits are at least about $1,500. Because if you have 2 credit cards with $500 limits, guess what? It's not really telling the lender a whole bunch about your ability to manage credit. So make it a little bit more substantial and it'll get their attention. Now let's talk about capacity. Okay, so you're of great financial character and you've been looking after your credit well, but at the end of the day, you have to make enough money to be able to service the mortgage, to pay it back on a timely basis, and we call that capacity. So there's 2 must-haves when it comes to capacity. One is the gross debt service, and what we do there is we look at your mortgage payment, your taxes, that's your property taxes, your heat allowance, so we usually use about $100 for that, and half of a condo fee if that's applicable, and we divide that by the household income available. And by household income we mean gross, not after your taxes have been deducted. That cannot exceed 39%. There are times when we have to use a lower ratio for weaker scores, but for the most part, most of my clients have to meet a 39%. The second calculation, and this gets people, is that you take all your household debt and then you add your other debts. So think about car loans, balances on credit cards, maybe student loans, and you take all of those debt payment requirements, add it to the household expenses, divide that by the same household income. That cannot exceed 44%. So as you can see, there's not much difference between 39% and 44%. So if you go out and you buy a really expensive vehicle without thinking about your plans for buying a home, you might find yourself disappointed with what you can afford for a home. So you have to think very holistically about your credit with a longer term view. So high ratio mortgages, those are the ones insured. There's another little catch for this, and this is why when you go on the internet and you do your mortgage calculators, you will find different answers, because there are a number of complexities built into how you qualify now thanks to federal legislation. So when you do a high ratio mortgage, you have to pass a stress test. And many of you may have read of a stress test. And that basically means that we're going to see if you could afford the mortgage payment if it were at a higher mortgage qualifying rate. In October 2017, that's 4.89%. Okay? Actual rates are really in the low 3%. But if you could afford that same mortgage at 4.89%, then you'll pass the stress test. That stress test may be applied to low ratio mortgages in the future, and the government is currently looking at it, but as of right now, you can use the actual mortgage rate, which will certainly help with the qualifying. So what income qualifies? Well, first of all, if you're looking for a home, don't be changing jobs because you can't be on probation. Salary is obviously great, easy to use, same as guaranteed hourly pay. Wonderful. Now, if you're on variable pay, that's fine too, but you'll need 2 years history of that. And we will use tax returns and take the average of that to qualify. And the same thing goes for those of you that are involved in self-employment. We'll need 2 tax returns for that. Now, as a self-employed person, not all of the income in the business may be claimed personally. We have ways to work with that as well. So just be aware that if you're in those circumstances, it's best to consult with a mortgage professional, and we'll walk you through that and make sure you know what you can afford. Collateral is our next C. Now, this means, is the mortgage provided still allowing for a margin? In other words, do I have a little bit of room to maneuver as a lender if things go sideways? So one of the things they're going to look at is the marketability of the property. And to the degree that the property is in a major city, the property is fairly similar to other properties in the neighborhood, that's a highly marketable property, and it gives the lender a lot of security that when the time comes to sell it, that the value will be there. Properties that are less marketable, but still we can get financing on, might be things like acreages. Not everybody wants to have an acreage, so the marketability is relatively less. There's fewer lenders, but there's still plenty of choice. So that is just a consideration that the lenders will look at. They'll also look at the amount of down payment. Consider this. If you do 5% down, the premium is 4%. You really have 1% equity in your purchase. So there's not a lot of margin there. However, it is an insured mortgage, so that gives the lender a lot of comfort right there. Now, when you have higher and higher amounts of down payment and a marketable property, then there'll be no concerns as far as the collateral of the property. So, what are you able to provide as collateral? Well, you can provide savings, obviously, but when you do, we have to provide 90-day history. The government insists that the lenders understand where the money came from. Now, obviously, if it's coming from employment, you don't have to have 90 days history. We'll see it right in the bank account. But plan on having at least 90 days evidence that you have the down payment. The other one that's really good for first-time home buyers is the RSP Homebuyer Program. This allows each eligible person to pull out up to $25,000 and not have taxes deducted from it as would ordinarily happen with RSP withdrawals. You do have to repay it over the next 15 years, but there's lots of time for you to get that money back in. The last one I wanted to highlight is gifts from relatives. And we're talking about blood relatives, very close, mom, dad, grandma, grandpa, brother, sister. If they are available to provide you with a down payment assistance by way of a gift, which has to be non-repayable, that is eligible as well. Lastly, I'll just touch quickly on borrowed funds. It is possible to borrow funds, but it's much more restrictive now than it used to be. And again, this is probably an area you want to talk to your mortgage professional and find out if you are able to do that. Now, we'll end on capital. Capital is, does the person have the financial cushion for the unexpected? You know, things happen. Unexpected expenses, job loss, interruptions of other kinds of income. So they want to make sure that there is some flexibility in your finances, that you'll be able to look after this mortgage when life's little bumps come by. So one of the things they would look at is, are there savings beyond the down payment itself? That's very helpful. How about the net worth? Is there a little bit of fallback position? And the other thing is there unused credit capacity? So if all the credit is kind of tapped out, then it doesn't give the lender the feeling that there's a lot of maneuverability for people. The lenders will usually require let's say a half to 1.5% of the purchase price being available for such situations. Again, we can play around with that a little bit when cash is tight, but those are generally what we're looking for. Now, that's your highlight on the 5 C's. I don't expect you to be going out and writing mortgages and stuff, but at least it gives you an idea how the underwriter is going to look at your circumstances, and with further consultation, I can certainly help people get ready for that. So what are the next steps? Well, before you even grab Vicky and go look at properties, you need to know what you can afford. Because one of the worst things that could happen is you fall in love with a property and then you go to finance it and find out you don't qualify. That would be heartbreaking. So what we want you to do is get yourself a pre-approval. Now what a pre-approval is an indication of what you're likely to be approved for. And I say likely very deliberately, because the underwriters do not physically look at your application. They'll provide you with a rate hold for up to 120 days, but that's as far as it goes. So again, you want to work with an experienced mortgage professional that will take their automated approval system and look at the details of your application and make sure that Once a live person looks at your application, the likelihood of approval is high. Okay, that's the pre-approval. Now, you go out with a pre-approval, you go look for places with Vicky. The next thing is you find a lovely place and you negotiate a good offer. I get a hold of that offer, and now I'm going to send it into the lender. I've collected a lot of the documentation up front so that we can move fast. We're well prepared. We are avoiding surprises. Now it goes into the lender. They look at it. They love it. They send it back as a conditional approval. The conditional approval will be subject to them verifying what we've said about you. For example, how much you earn, where the down payment came from. And they'll want to know that the property's value is everything it needs to be. So that's the conditional. Once we've cleared all those conditions, we're going to get what's called a full approval. And this is a very exciting moment in your purchase journey, because at this point, you're able to say to Vicky, let's waive our financing condition, which she has put into your contract to protect you in the event your financing is not approved. So now we've got that taken care of. Once we got to the full approval, the lender will instruct your lawyer and let them know what they need to do to secure the mortgage on your new property. Now, what to expect overall? You need to expect that you're going to have a lot of time invested in this, and in the market there are so many lender opportunities. If you just go to the ones you're familiar with, then you're probably not going to feel a lot of peace of mind that you've got the best offer out there. So you want to work with a mortgage broker who will deal with dozens of different lenders, look at the different opportunities for the small print, the things that might cost you in the long run, and the different flexibilities that will help you reduce your interest costs. So you do all of that, and one of the nice things, having worked in banking and now being a broker, is that rather than representing my lender, is now I'm working with my customer, searching across so many different lenders, not being biased as to selling just a limited number of mortgages that I may have available. So I'm going to save time, I'm going to save money, I'm going to avoid bad decisions on your part by showing you what the fine print is, and at the end of the day, you're going to have this peace of mind that you've made a great decision. So thank you very much for your time and attention. I wish you all the success in the world at finding the right place, and you're in the right hands with Vicky. And Vicky, back to you.